as
Oh, look at that. That's fancy.
boom.
I
So
like that.
I think it's recording. Unrivaled Nation, I got a special treat for you after hours.
Okay.
So as you know, as regular viewers know, I'm a big fan of Warren Buffett and Charlie Munger. Not only because they're like superstars, but incredibly smart. But what I really enjoy about them is that they can have different opinions. And the fact is that they don't argue with each other. They can just disagree. And one of the things that I really like is that Nelson strikes me as a super smart guy. He's a good quality, good friend. And I don't always agree 100%. Like we have very different theses on what we want to operate on or what we want to focus on. And you're gonna hear one of the key things that he's focused on right now, which is oil, which I actually think is really interesting, even though it's not really part of my portfolio right now. So I want to do this video with you and to share Nelson Wu with the world. And Nelson, you want to share a little bit about your background, you know, what you're doing these days, so that way people can hear about it from this platform?
Yeah, sure. No, it's great to be on here first of all, and you know, Dan, you and I have always had great, interesting conversations through the years about, you know, different themes and things like that. So it's great to you know, appear on your show. So I think so I am the founder and the CIO of OpenSquare Capital. It's a hedge fund. We currently have a running theme about oil and an impending energy shortage that we see coming, and it's something that we've been actually chasing for quite a while. So we've been in the thesis for about 3 to 4 years now, and so it's one of those themes where you know, we think we're close, but something always happens. We always experience a black swan, something like a COVID situation. But as you know, time progresses, as you know, as investments are not made, we think we're getting closer with the theme coming to fruition. So it's a very different play than, you know, most of your stock pickings that you do in terms of value investing. It's a little bit more speculative, but it's definitely one of those macro theses that we think may be coming true in the near term. So.
Yeah, so do you want to talk high level about the thesis in terms of what you're seeing right now? Because I think it's worthwhile for people to understand that you effectively said, hey, recognize oil prices have been one of the best performing assets this year as people are sort of waking up. And you're effectively saying, yeah, and this might just be the start of the run. You could potentially see maybe a double from here or something like that, which I think would shock a lot of people, you know, especially when you see folks like Cathie Wood, and she's been the growth, you know, the go growth banner, you know, incredible track record over the last few years, effectively say, hey, I don't think oil's going to go past 70. I think it's going to turn around. So I'm curious to hear your insights there. Like what is it that a lot of people are missing right now? And sort of what are the data points you're seeing?
I see. Yeah, so, you know, one of the interesting things about the oil thesis is that it really started about 5, 6 years ago. So what we had a world where oil was about $100 in 2015, 2014. So around that time, it was a little bit over $140. You know, it kind of just moved up and down between 100 and 140, somewhere there. And it was one of those things where, you know, US shale production really became the marginal producer. It really just uplifted everybody's production in terms of ability to supply things, ability to service the energy demands of, you know, a growing Asia. You had a growing economy in India, you had a growing economy in China. And so really, most of OPEC and, you know, for the most part, non-OPEC production had just kind of flatlined. But then up comes along the upshot, the US production in the Permian. And then with that Texas production, that really fueled the growth for an exponential increase in production for the global appetite, basically. And so what you then had was in 2015, that production really just started taking off, you know, like a rocket. And so, you know, oil's like any other commodity. When you have too much supplies, you know, the prices obviously come down because your demand for oil really kind of goes up along with GDP. And so GDP rises 1 to 2% a year, and that global appetite for oil rises about 1 to 2% a year. And so some years faster just because you have Asia growing faster, but for the most part, it rises about 1 to 2% a year. But with shale growing so fast, that quickly swamped the appetite. And so then you had a supply demand imbalance, oil prices crashed in 2015. And since then, it's been kind of hovering around the $50 to $70 range. And it's been in that range for quite a while. And so, as we looked into the thesis about 5-6 years ago, we said, even at this range of $50, $60, it's just not enough to sustain production. Eventually, what you're going to have is you're going to have an underinvestment. And then eventually your supply demand balance is going to swing the other way. You're going to have high demand because demand continues to rise with GDP, and then you're going to have an undersupply. And in the oil business, if you have 1 to 2%, which is basically 1 to 2 million barrels a day of undersupply, you're going to have reflexively $100 oil. And so we're going from a $50 to $70 range. And I think we're, as we've undersupplied and underinvested in the last few years, we're actually going to be looking at probably triple digit oil within the next year or two at this point.
Wow.
So that was kind of the 5-year thesis. I mean, that was kind of the 3-year thesis. And so we saw a taste of it in 2018, because then oil went back up to, from a low of $50 back up to about $80. And then, with the US-China trade war coming along, that really just, completely leveled out 2019. So 2019, we didn't really grow that much in terms of overall demand because the US-China trade war really, really dampened the appetite for oil globally. And then we were thinking, okay, well, 2020 should be okay because, we started off 2020 in the year, January, February, oil started going back up to about $70. And then obviously COVID hit, right? And COVID is just one of those things where it's a black swan on the entire oil complex. And at the same time, OPEC was trying to decide, hey, should we pull back on production? Should we agree to something where we can reduce production? Because obviously demand is just going down the cliffs as everybody goes into lockdowns around the world. Unfortunately, they weren't able to agree. Saudi instituted a price war and said, you know what, if we can't agree, then we're just going to pump as much as we can, and we're going to flood the market. So that strategy sent oil reeling, went down to the $30 range, $20 range. Eventually, oil hit negative.
Yeah.
And that was the first time in history that I actually did that. But pretty soon, the cartel came around, OPEC Plus came around along with Russia and decided, hey, we really need to manage this market for at least the foreseeable future. And so in 2020, in about the mid part of 2020, they decided on spare capacity cuts. And so they really just cut production. And then since then, they've been managing the market on the uptrend. So we hit a negative number, which has never happened before on oil prices. And then now we're seeing that reflexive rebound of just supply demand catching back up itself, especially as the world starts to, re-engage economically. And then, we're now seeing the consequences of the supply gap through the first 4 years, and then now especially into COVID and coming out of COVID. And so, we're seeing the oil prices start to really inflect upwards since January. And you're seeing that pickup every single month where, inventories continue to slide down because there's just not enough supplies for the recovering demand that we're seeing right now.
So what I'm hearing, and I'm reading like effectively, because I'm not super close to oil. You are so in the weeds on oil. And so I'm more of a generalist looking for these, growth companies. You're largely focused on oil. That's the vast majority of your focus right now. That's how you're managing your capital. And so you're looking at inventories right now, and you're watching them go down on a global basis. So I take it you're looking at inventories around the world, put together a composite and say, hey, this is effectively your margin of safety. This is your cushion. And each day, each week, that cushion's getting a little tighter. Is that the right way to think about it?
That's right. Yeah, that's a good way to put it. You know what, we're looking at a couple of things. So we're looking at not only just inventories, because that, like you said, that's our cushion, that's our buffer, right? Yeah. But you're also looking at just the amount of capital expenditures that you're plowing into the field, because what you put in is what you get out. And so, oil is like any other commodity. If you stop investing in it, the decline rates on each well really starts to show, right? And so you can actually see that, as we've, just to go back, 4 years ago, once we started cutting CapEx because oil prices went from 100 to 50, we started lowering CapEx. And you saw international oil companies, you saw US oil companies, everybody just started tampering down CapEx. And so we cut about
just for viewers to understand, when you say cutting CapEx, it's effectively saying no new wells, correct?
No new wells, right, right. So no drilling of them, no fracking of them, and then also no new projects like international or on the water, like high seas rigs, the things that you see in the Gulf of Mexico, the things that you see in the UK, right? And so really all those projects stopped. Right. And so what it became is, hey, let's only drill in our most profitable places, right? The places where we know have a lot of oil. But that's an existing inventory. It's an existing land mass that has oil, but eventually it kind of goes away because you've drilled up all the sweet spots. Mm-hmm. And so that's kind of what you've seen in the last 4 or 5 years. And then, so that is a reduction of about 20% of CapEx, right? So we're going to commit about 20, 30% less capital expenditures, just because oil prices are lower. And so we just don't have as much free cash flow. We can't borrow as much. The public markets are shutting us off. And so that was the last 4 years. And then what you see is in 2020, then the tsunami hit, right? The black swan event where, oil prices crashed. And really nobody was profitable. So at that point, it was just more of, who's going to survive this black swan event, right? Mm-hmm. And so what you've seen since 2020 to today, so it's about a year going into a year and a half now, is that CapEx then got taken down another 20%, right? Mm-hmm. And so now we're effectively down about 30, 40% from what we normally would invest. And so what you're seeing is just, you're having unsustainable CapEx investments for the demand that's actually going back to pre-COVID levels, because we're just individually just creature of habits, right? You still commute to work, you still want to take leisure vacation, you're still traveling to see families, and you're still taking, weekend trips, right? And so our oil demand is actually starting to recover as some of the healthcare restrictions are starting to lift. And so you're seeing that in the US, you're seeing that in the UK, slowly seeing that in Europe. And then we think in the second half of the year, you're going to start seeing that in Asia as some of those restrictions lift. And so as we recover, we're going to go back to 100% of demand. But then yet we're spending 30 to 40% less on CapEx for oil investments, which means no drilling of new wells, no oil. And that shows itself as you see inventory start to slide, because now we're dipping into the stores.
And so, and not opening new wells is a problem, because if, let's say, demand gets back to where it was in 2019 or 2018, mm-hmm. and you're effectively saying the existing producing wells are declining. It's a depreciating asset, depleting asset. You only have 20, 30 years, however, maybe 10 years. I don't know on the individual wells. And so their throughput is going down each year. Is it to the tune of what percent generally should we be thinking?
It's that's kind of a swag figure. Some people say it's about 6, some people say it's about 8. So if you think about it in that terms, I think that's a pretty roundabout way of thinking about it. But if you also think about the U.S. can be the world can be kind of divided between producers who are in conventional spaces and then producers who are in unconventional. And unconventional is kind of the shale that you think about. So everybody's thinking about, the prolific Texas shale, the Permian Basin. Those unconventional producers, their wells, the U.S. is about 14, 15 million barrels out of the total worldwide supply of 100 million barrels. And so every day we consume close to about 100 million barrels. And so the U.S., effectively supplies about 12 to 15% of that. And so with the U.S. churning that much of the overall supply, the U.S. has become the marginal supplier. But their wells, the unconventional wells, they lose about 50% of their production in a single year.
1.5 or 5?
50%, 50.
Wow.
50. Yeah. So if you think about it, it's a little bit like a Coke bottle with a Mentos in it. So it'll just shoot up dramatically. It'll give you full-on production, and then it'll just peter out pretty fast. And so that's what shale wells give you. The conventional stuff, when we talk about the 6 to 8%, the gradual decline every year, that's the brownfield projects. That's the big Exxon, drilling rig in the south, in the Gulf of Mexico.
Sure.
Those things tend to decline a little bit slower, right? But the shale wells are the Mentos Copilot ones. They just come out and then they'll peter out fairly fast. And so those things you have to continuously reinvest, because every 2 years that well is about dry. So you have to continuously reinvest drilling into it.
And
so,
I'm sorry, you were saying?
Well, no, go ahead.
I was going to say, what's the risk that you have in terms of the oil thesis? You effectively see oil, let's say, pop to 90 or something like that. And then that's enough to entice, let's say, the marginal producers to come online. Is there just like, am I thinking about how long it takes for them to actually come online? Like what prevents that from going to oversupply like that? I guess if you see oil, instead of doubling, only going up 10%.
There's always, because the oil is such a macro thesis, you tend to take along on all the macro risks, right? A slowing economy, for global war, global pandemic. So anything that affects the world economically, you're gonna have some impact. But the question just becomes whether it's big or small, and then whether the cadence of our current recovery continues. I would say there's probably three things. One is just the global macro picture. If we continue to recover, then all things should recover, and as well as our appetite for energy. And so our energy demand will continue to cover. But if for some reason we slide into a depression or even a recession, a great recession, then obviously you're going to have a hit on the demand side. And so although you are undersupplied, or at least we think you're undersupplied right now, your demand could come down, it could balance out, and so your oil could either go negative or it could just stay in place, and so you don't have that appreciating oil price.
So for your oil thesis at this point, are you more concerned on the supply side or the demand side? Like as you're looking,
it's always been a supply issue for us. Yeah, so it's always been a supply issue for us, just because we can track that, and quite frankly, demand is hard to track, because demand is something that you can infer from how the inventories are working, because you have a pretty good picture about supply. You have a very good picture about inventories, and then the net of those two things is just demand. And so if you see, though, that global economic GDP is recovering, all the PMI indicators are good, then you have a pretty solid idea as to, okay, well, economically, this country is recovering. So, they typically consume, let's say, 5 million barrels a day. India consumes 5 million barrels a day. If you see their GDP continue to rise, you can pencil in 5 million. And so that's kind of how we do it. There's other readings you can do, like airline traffic, air passenger traffic, and also gasoline miles driven. So there's other ways to kind of ring fence it, but on an overall basis, if you're looking at GDP recovery, that's usually good.
There are so many data points you have to look at just to watch the thesis, like airline traffic, or like what's going on in India. And I take it like that also becomes like part of the thesis as well, which we spoke previously, where you mentioned effectively a lot of countries are in the thick of it right now with COVID. As they come back online, hopefully later this year, maybe the beginning of next year, that is actually fuel on the fire for a country like India or Brazil. Is that the right way to think about it?
Yep, that's exactly the right way to think. If we in order to do the oil thesis, in order to continue to survive the oil thesis, and trust me, 2020 was one of those years where you just wanted to survive. If you can survive, you knew that we just can't have 100% of demand recovery and then spend 30% less than we did when right before that. Inventories were fairly balanced, supply demand was fairly balanced, and supplies was starting to trend down, and demand continued to trend up, right? And so you can't have that where now we just completely killed CapEx. We're down about a third, and we're expecting the same amount of supplies. It just doesn't happen in anything. You can go down any list of commodities right now. You can see all the commodities going up. It's the same issue, and so. Metals and mining was, occurred in 2014. Their crash happened about a year earlier than oil, but the same issue is going to affect oil as it did in metals and mining. So that's why you see copper, palladium, all those things start to really trend back up, because this is one of those cyclical things. And so you're starting to see the backslide of what happens when you really reduce CapEx.
Got it. And so I guess in a really favorable situation for you, like if the bull thesis, oil thesis really plays out, I mean, you could potentially have a spike potentially as, let's say, inventories work their way down and you see that demand. Like you know, almost like the opposite of going into negative territory. You could even see, you know, well into triple digits. You know, is that the right framework that you're thinking? Or
yeah, I think so, because normally, you know, if you had a situation where inventories were sliding at the rate that they are doing. So for instance, the US is going down by a rate that is the highest in the last 40 years. So every day we're losing about 1.2 million barrels in the last couple of weeks, the last 4 or 5 weeks.
of inventory, like of cushion.
Of crude inventory. Yeah, it just keeps sliding down. And really that's just the delta between what you're able to produce, what you're able to import, and just your demand. Your demand.
And what's the cushion total?
The cushion total on a worldwide basis, it's about 150 million. But at the rate that we're burning through, we should burn through all of it by late August. Late August.
Whoa.
Yeah. So then we're dipping into what they call the 5-year average. And so what we typically do is say, well, if you're below the 5-year average, that's when oil starts to get really tight. And so we're about 150 million barrels above the 5-year average, but at the rate that we're burning through it, you've probably got another 4, 5, 6 weeks, if that. Right. And so,
wow. And have there been periods in the past where inventory gets all the way drawn down?
Oh, absolutely. Oh, no, and it will never really draw down, just because you're always going to have some inventory in the pipelines. You need some inventory in the factories to run.
Sure.
You're going to need them in the refineries to run. But it gets to the level where, you know, once it draws down, let's say by a couple 100 million barrels, you know, below that 5-year average, yeah, your oil price is already well into the hundreds. But then that spurs production. But that's just the way commodities work, right? Once it gets so tight that, you know, prices start to really inflect, then producers of all ilk will start producing.
So you're effectively saying we're going to be reaching sort of a harrowing part of the cushion by the end of this summer. Let's say September. So end of August, September, we're going to be at a point where people are going to, around the world, will be saying we're not producing enough oil. And at that, unless there's some sort of macro on the demand side,
that's right.
Saying it would be impossible to bring the supply side up to speed in, let's say, the next few weeks. And so it's really just purely demand. So if demand just stays here, but right now you're seeing indications demand's actually going like this, going up.
Yeah.
Then you're saying this thesis plays out over the next few weeks, even potentially.
It gives you more certainty as the weeks go on. So into the year end, you're going to see demand continue to rise and supply is really straining to catch up. Because you'd asked me earlier, you know, what I think is, you know, the issue surrounding oil. Like if there was another black swan, or if there was another headwind to oil, what would it be, right? There's two things, right? So there's three things. One is the macro that we talked about. The second thing is really
the demand macro. The demand macro, just
the demand macro. Yes,
China slowing down, some sort of country, like maybe the pandemic gets worse. There's some sort of weird period, something like that.
Yeah, or let's say that the Fed loses control of inflation, they have to tighten severely. Sends everything down into a spiral, right? But let's talk about the supply side. There's a couple factors there, right? So if, let's say, OPEC plus, right, which is OPEC plus Russia, right? That's effectively those two. And when I talk about OPEC, it's really Saudi Arabia. So Saudi Arabia and Russia. So if those two guys, you know, come along and say, well, you know, we're going to just produce the max, right? Then oil analysts have said, well, then they will immediately flood the system. There's going to be too much supply versus demand because these guys have spare capacity, right? And so there's a question about how much spare capacity do they have? And most analysts will say it's about 5 million barrels, 6 million barrels, somewhere there. You know, our analysis says that it's about 3. And so right now, if we look into the year end, we think what's going to happen is you're going to have about a 5 million barrel gap between supply and demand. So that's a 5 million barrel gap. And so if OPEC Plus can bring back 3, you're still going to have a 2 million barrel gap. And so what we think is going to happen is then Iran's going to step in, because somehow the US and Iran's going to figure out a new JCPOA, the nuclear agreement. Then they can bring back another 1.5 to maybe 2 million barrels. And so that's how you get to 5. Right. Now, analysts will say, well, no, it's 5 to begin with, and then the 2 from Iran, so that's a 7. So you're going to have 2 million over supply. But I don't think that's going to happen, just because if you just look at the rig counts, the actual machines drilling wells for OPEC Plus, it's just not there. It's a third lower. So when they say, well, they really have 5, OPEC Plus really has 5, that's assuming you have the same number of rigs, but now you have 1/3 less rigs actually drilling holes into the ground, spudding new wells. You don't have that spare capacity, because that spare capacity, what you thought was 5 to begin the year, well, that's actually dynamic, right? That's just based on how many rigs. And so the question is, well, can you reintroduce rigs that quickly? Can you spud those wells that quickly, bring along 5? Just don't think so. I mean, that's a huge amount of resource commitment. That's a huge amount of capital that you have to deploy. And then frankly, it just takes time. It takes you time to drill the number of wells that you used to drill a 1.5 years ago. Because by the time we start doing this, we're talking about wells that you used to drill, the number of wells you used to drill 2 years ago in January 2020, right? Before all of COVID. But for the last 2 years, you haven't done anything. So now you've fallen off a little treadmill, you got to race back up to catch up. And that's a really difficult thing to do in a short period of time.
Got it. So,
right?
this gets back to the point of, like, it's just tough for supply to quickly catch up if inventory cushions start. Yeah. Was there more potential, thesis that deal busters?
Yeah, so that's the second. And the third one would be the US production, right? This prolific Texas production in the Permian, right? So we've said in each well that you drill, within 2 years, they pretty much sputter out. They still produce a little bit, but nowhere near what they were. So we are 2 years into this, right? And if you think about year end, we're already kind of 2 years into it since COVID really cramped down on us in 2020. We've lost pretty much that production. Production for the US is pretty flat right now. Oil prices have gone -37 all the way back up to $72 today. Right? WTI is printing at $72 per barrel. US production is flatline, right? And there's a couple of reasons for that. One is they were near bankruptcy last year. So the trust amongst the investment community is really iffy, right? US shale has never been really good stewards of capital, because every single dollar that they earned from 2015 all the way to today, they plowed back into production, right? And so there was never really return of capital or even return on capital. And so for most investors, US shale or even just US oil companies just isn't someplace that they want to invest. And so if you look at the S&P 500, the component of energy is about 2%. And that's just because of investor apathy. The second issue on that, though, is ESG. So we're going through this revolution where we want green energy, we want net zero, we want to really work on the climate change issues, right? And so unfortunately, how they're going about it, how the environmentalists are attacking the issue is really just attacking supply of fossil fuels, right? And so theoretically, it should be two things. It should be, let's work on, demand and making sure that, we're conserving as much as we can. Let's make sure that we've got technology to service that demand if we want to eliminate fossil fuels, which is maybe natural gas, solar, wind. And then let's work on supplies, because on the supply side, as much as we want to change, our energy consumption habits, we're still driving. Right, we're still driving, we're still flying, and not only that, but we're recovering on those items. And so, but the ESG themes have run amok, and so now, well, I would say amok, but other people would say it's on track. So that's really a personal decision on most people's parts. But for the investment community and for Wall Street, that's become a mandate. Right, you have to have ESG mandates, you have to have climate change mandates within your investment themes. And so if those are within your investment themes, then then effectively it really just says, I can't invest in my fund in fossil fuel companies, right? And that just eliminates a wholesale sector of the energy components, the US, Canadian, globally.
But that's
And so
effectively part of the pull argument.
That's right, yeah. Because that ties right back in. If there's no money available to drill,
yeah,
right, there and investors aren't committing additional capital, then your supply situation where we reduced capex by 30%, that's going to stay in place, right? Because there's just no new money out there, right? You can refinance the bonds that you currently have. That money's still available, but you can't borrow for new drilling, right? And also you're not going to be able to issue a lot of shares because, number one, the shareholders are now in control, and the shareholders are saying, hey, you got to have some return on capital, and you can't dilute the shareholders to issue new shares, raise capital to drill, because we just don't want you to grow at this point.
No.
Every single dollar free cash flow should go back to us, whether it's in a dividend, a buyback, or just park it in place, and then that's your cash reserve.
That's a really good point. So over the last 2-3 years, because you had effectively this harrowing experience that wiped out a lot of firms, you effectively have the debt become the equity with a lot of change of investor base. They're focused on, hey, I want to get my money back. It's not about let's issue more stock. And so they're not in a position to say, hey, we weren't originally equity investors. We're in this situation. We're not looking to plow more into it. We just want to get our money back. And so that's I think you're saying is a key crux of the US argument, or perhaps globally, is that you're not going to see the supply really ramp up because of that.
That's right. Yeah. And so, and what's interesting is that even on the U.S. company side, if you think about just management teams, board of directors, they're compensated by stock, and so a lot of these executives, directors, they receive stock at the very low of 2020s, right? And so, if we're talking about really a climate change, ESG transition in the next 10 years, where, fossil fuel, let's say we really do get away from fossil fuels, and then in 10 years, we are able to just transition fully to green energy. This is almost a one last bite at the apple for these guys, right? And so if you had received stock options, if you have a slug of stock at very low strike prices, a very low basis, you're going to try to do everything that's favorable for the shareholder because it benefits their pay packages, right? And really, if it is true that we do transition in 10 years, then you could have a lot of trapped resources in the ground, right? A lot of trapped value in the ground that you're just never able to extract, unless you're able to, do what some of the E&P companies are trying to do, which is, get into green energy, right? And then shift that business model. But let's say that doesn't work out well. You're going to be an E&P driller for, the next 10 years. Then in this time period, your concerns are the same as your shareholders, and your value drivers can be the same as your shareholders. So
let me make sure I understand this. Because you've been involved with oil for some time, but you effectively have a fairly short time horizon on how this could play out potentially just over the next few months. So in your opinion, are you thinking about this as a 5 to 10 year thesis, or are you looking at this as a hey, if this comes to fruition in the next 3, 6, 9 months, where this goes triple digits, $150 a barrel, at that point, thesis is over. It was that's it. I'm done for the game. Or are you saying, hey, I'm playing for 10 years out, or something else?
So when we took on the thesis 5 years ago in 2015, 2016, we were thinking it's going to be a 3-year thesis, right? And so by 2018, oil had gone from give or take $40 to about $80. And so that thesis was really panning out. And then in 2019, obviously the US trade war, 2020 was COVID. None of the facts have really changed. It's just more of circumstances that affected it, where the divergence between demand and supply has really really just blown out at this point. And so, and it's not surprising just because, you know, a black swan event will have black swan repercussions, right? It's just some of these things take a little bit of time. And so, you know, as we recover now, you know, we're seeing massive inflation on, you know, a lot of the other commodities. And as we shift from buying things, right? Because all of 2020, 2021, as we've gotten stimulus checks, we've been buying a lot of things. And so that buying of things has really driven this consumption of goods, right? And so that's why you see a lot of the metals mining, a lot of those types of things really start to get expensive. But as we shift to doing things, as health restrictions lift, as we're starting to do things, that momentum swings to the other direction, right? And so as we do things, that's really just energy consumption. And so that's why energy consumption will continue to not only get up to 2019 levels, pre-COVID levels, we think it's going to actually be higher than that. Because now we're traveling in our own personal bubbles. We definitely take more car trips than public transportations, things like that. And so there's some consumption issues that is going to take us back into pre-2019 levels and likely beyond that. And then for the next few years after that, it's going to steadily recouple to what we used to do, which is energy consumption continues to rise as GDP rises, right? And so if you think about India, if you think about China, the global economy, right? India makes, each per capita person makes about $3,000 per year. China is about $9,000 per year. And then the US is $60,000 per year, right? So just from that per capita basis, you obviously know India is growing. You obviously know China is growing, but the amount of growth ahead for these countries is just staggering. I mean, to go from $3,000 in India to, let's say, even $35,000, which is Korea, Taiwan, Japan. I mean, those are staggering growth. I mean, that's a 10x figure, right? And then for even China, that's a 3x figure, right? Which means that there's significant runway ahead because you have about 2.5 billion of population in Asia just growing exponentially for the next 10 years. And you can't expect them to, you know, turn around and say, well, your energy costs are going to increase because you have to transition to green energy, right? Just because if you're making $3,000 a year, you're probably using biofuel, right? Yeah. You're burning wood, right? You know, you're probably burning dung, right? And your next transition will probably be not the coal. That's the next step on the energy transition ladder. After coal, then maybe natural gas, maybe oil, right? And then after that, then you can talk about, you know, green energy, solar, wind, and then we can talk about EV, right? But even before all of that, we have to get away from biomass. But it's just unrealistic to think that, you know, a lot of these countries, India can go from you know, biomass all the way to green energy, or China can go from coal all the way to green energy. So for these countries, their first priority is we have to get out of poverty, right? For political stability reasons, China, or just from a population growth perspective, from India's perspective, we just have to get out of poverty. And so to say that, you know, we need to migrate to clean energy and then that's going to happen within 10 years, we just don't think that's likely. I mean, if you look at, you know, and
global perspective.
From a global perspective, yes. Yeah. And so, you know, certainly like climate change is going to happen in the next 10 years. If you believe in climate change or if you believe in the science around it, you know, we certainly do. So it's not something that we completely dismiss. It's just the economic cadence of migrating away from fossil fuels is really difficult, especially when you have, you know, Europe, especially when you have the US as a percentage of the 2 billion people in China and India that are trying to grow their way out of poverty. That discrepancy is very, very.
Because I asked, is this sort of a short-term thesis versus a long-term? It sounds like it could play out over the next, let's say, 6 to 9 months, at which point you'd revisit, you'd probably be sitting on a nice gain. But the reality is you're sort of saying this could actually be a multi-year run, potentially.
It could, yeah.
Based on that demand aspect over time. That said,
in the supply aspect.
Exactly. So there's that it becomes very murky looking out. But you're saying at the very least over, let's say, the next year, unless there's some sort of demand shock, you see, triple digit oil.
That's right. Yeah. Yeah. And so it's one of those things where, like any investment, especially something like oil, where you take a lot of the macro risk. It's just inherent in the thesis itself. And so when you do that, then obviously you're going to have to be more tactical about it. And so for us, it's more of a strategic investment where we're saying, hey, look, the supply figures just don't line up, especially if you recouple demand up to 100%, right? And so you'll see that in the next year, because if we're true, because we've been in this for 4 or 5 years now, and so it's worked at some points, and then obviously you take on external factors, but now it seems to be working again. And so if it does really deliver the price spike that we anticipate, you should see it within the year. And then after that, you can come and revisit it, right? Because you can exit and then you can decide, okay, well, what are some of the other implications to, the $100 oil? What are some of the implications of, slowing down energy transition? Because now we have to reinvest from green energy back into fossil fuels, right? Because it's not like if we hit 100 oil, all is well and all is good, we'll just transition to green energy. We just don't have enough supply of green energy globally.
So that's the key part that you're effectively saying. Here's where Cathie Wood is wrong. Is when she keeps talking about there's no way it goes well but above 70. Is you're effectively saying, look, we just don't have that many EVs out there that can move the needle on it. Elon Musk, as much as he wants to increase production, you're looking at a huge pie and you just can't change it overnight. So even factoring in that aspect, that's the reason why over the next year you see that play out. And then revisit in a year from now, or sometime between now and a year from now, you're saying oil's 140, 150 potentially. And then then you're sort of saying what's the picture at that point? If you have this, let's start wrapping this up, thinking about it. So the ways to play this, some people do, effectively do contracts that are a straight play on oil. Some people will buy the individual stocks. If you were to see, let's say, oil at 140 a barrel, do you see that, which would be effectively 100% from here on the commodity? Do you think the underlying producers would see, hundreds of percent, or thousands of percent? Like, do you see them catching that rally and rallying with them? Because you can find a few producers right now that are effectively trading at a 20% plus free cash flow yield. And I'm sort of saying, wait a second, what's the discrepancy here? Because that effectively says oil prices are going back down, at least when I see that.
Yeah. So, I mean, there's a few ways to play it. If you kind of divide the oil complex into upstream, the actual people who drill, the companies that actually drill the wells in the ground, the midstream, which is delivering the oil from the drillers to the refiners, and then downstream, which is the refiners themselves. There's a whole host of companies in there. And so the easiest way that I've told investors to do it is, if you don't have the time to look into individual companies and just the nuances of each individual companies, the risk aspects of each individual companies, just use ETFs, right? You can do XOP, which is focusing on the upstream drillers, right? And so that will have the highest correlation to oil prices, because those guys really just deliver it to the midstream guys. The midstream guys delivers it to the refiners. It gets refined into gasoline, jet fuel, diesel, just by the drillers, right? And so that's going to give you probably the biggest bang for the buck, right? And so
that's XLP is the top, the upstream folks. The other, are you considering the whole stack here with mid and downstream? Or
I don't usually consider the mid, because the mid, they're usually cash flow type of vehicles. So if you wanted a dividend or something like that, so you would typically invest in the mids. The mids are kind of what Buffett or Munger calls the toll takers, right? They just get a little bit of toll. They're always there, like they're the bridge guys, right? And so those are great. But if you're thinking about this thesis from an oil spike perspective, and it's going to help your portfolio just get some of the alpha, then I wouldn't go with the mid. right? And so, and then the lastly is the refiners. You can also buy a basket of refiners as well. I just think that in this initial ramp up, as crude gets expensive, now remember for refiners, that's an input cost. They buy crude, refine it into gasoline, jet, and diesel, and then sell the jet diesel. So that they make that spread, right? If crude gets really expensive, it's going to hit them first, right? Because that's an expense for them. And so I wouldn't necessarily buy refiners as well, but there is a way to play where you can just buy XLE. XLE are integrated companies. So just think about the biggest ones like Chevron, Exxon, all those large integrated oil companies. They own baskets of upstream production, they own midstream pipes, they own refineries, right? And so if you want to just buy the whole basket, the XLE would be the best way to play that.
Got it. So XOP is a leverage play on it, on the producers themselves.
It's not leverage, but it's a focus play on a subsector of the entire sector.
But they probably have leverage balance sheets, just given what.
Oh, for sure, yeah. Most of them have leveraged balance sheets. So that's the U.S. side. So XOP, XLE is the U.S. side, and then XLE you could kind of think of them as international as well, just because they're all integrated oil companies. If you want to go into Canada, Canada has a significant production as well. You can think about Suncor or Cenovus, right? Those are two of the larger companies in Canada as producers. And that's effectively like buying Chevron and Exxon, but in Canada. And so those are really good companies to kind of take your bet on rising oil prices. And so that if you did a basket of XOP, XLE, and then Suncor, Cenovus, that gives you a really good round out of geographical diversity, right? You've got America, US, and then you've got Canadian, and then also gives you just, a gamut of oil stocks with different balance sheets, different plays. One, let's say the US is focused on Texas, but you also have Gulf of Mexico. You also have, some other natural gas assets as well. And so it gives you a really good range of just covering the entire energy sector. And so that would help you as oil prices inflect up here.
Wow, that's thank you, Nelson. This has been really thought-provoking in terms of where oil could be just in the next few months or later this year. Do you feel like there's anything else or any key points you want to share, either about the thesis or about yourself, Nelson? A call out.
We write about it constantly. Me and a couple of other people. We're on Open Insight, which is a Substack that you can subscribe to. You can follow us on Twitter. It's OpenSquare Cap. And you can pull our articles from there as well. So, we tend to write one or two articles every week, just to kind of continue our research process, and it also helps us, quite frankly, to meet a lot of different investors and to gain that leverage from and knowledge from other investors. So that's been the fun part. So including yourself. So I mean, it's awesome. One of those things where it gives as much as you give. So it's a great thing.
Very great. Well, Nelson, I'll leave those in the description of this video, links to that, to these different sites. This has been really thought-provoking, because I think the world would be a very different place if in the next few months people wake up and they see $140 oil or 150. I think that really would be a reset for a lot of people. It's
going to surprise a lot of people, I think. But I do think quite frankly, if you go to Costco, or if you go to any one of your gas stations, you see those prices start to steadily rise, and there is a reason, and that reason really goes back to crude. If you continue to see those gasoline prices rise, you'll know crude prices are starting to really rise here. So we'll see. We've been in the thesis for quite a while, but we have faith in our research. So hopefully happier days are ahead for us. So
all right. Well, thanks so much, Nelson. This was great.
Hey, thanks so much. Talk to you soon.
Talk to you soon.